All right, good evening, everyone. Welcome to the CattleFax Trends Plus webinar. We thank you all for taking some time out of your busy schedules and taking some time out of your evening to be with us as we walk through and give you some updates on the market, talk about how we see things unraveling here in the next few months and where we've been and where we're going. So with that, we'll just go ahead and dive on in. But first, I do want to thank the continued sponsorship of Elanco. They've sponsored this webinar series for quite some time, and making this with their generosity, making this webinar free and available to everyone that wants to watch. So thank you, Elanco. So as far as the presentation that we'll go through this evening and what we'll talk about, we'll start off the discussion looking at a few of the outside factors. We all know that the economy, with inflation and the turmoil coming out of Ukraine, plenty of big question marks there, and there's no doubt that that's spilling over into the ag commodity complex and the beef industry as well. Feedstuffs on top of mind for everyone, and in particular, how that relates to drought. We know that conditions are certainly continue to be tough for a lot of folks, and we have gotten some timely moisture in some areas here over the past week, and that's been important. But this drought situation is clearly top of mind for many people. We'll run through and talk about, from the supply and demand side, specific to the cattle and beef complex, what we're seeing there and what we expect going forward. And then, considering this is our cow-calf webinar series, we will hone in a little bit on our expectations for the summer and fall calf markets. Lay out some broader expectations for these summer videos that will be starting up here before too long. And then looking on out into fall. And then we'll also talk about the results from our recent cow-calf survey, evaluating how operations and those folks who responded to that survey, what they reported as we close the books on 2021. And then finally we'll hear from Elanco. And I'm Patrick Linnell. I'll walk you through the first portion of this webinar and take a look at the market outlook. So taking a step back, I think a fair place to start is inflation, and again, the broader economy. You certainly can't pick up any publication or turn on the news, the radio, without hearing about inflation. The CPI, Consumer Price Index, was up 8.1% in April, and that comes on top of an 8.6% year-over-year increase in March. And as you look back, these are certainly some of the highest inflation numbers that we've seen in 40 years. Something very, very different than this kind of slow inflationary environment, this predominantly sub 2% inflation that we've seen for the bulk of the last decade, coming out of the back of the financial crisis and the Great Recession there. Now, as we look on forward, a lot of expectations are that the year-over-year increase of inflation may slow as you work through the bulk of the year, but on average, we're still looking at inflation that could be up north of 7% on an annual basis. Again, pretty significant rate of increase for prices all across the board. And as you think about what caused this and some of the implications here, the bottom chart looks at real disposable income in the United States on a per capita basis. So average income per person. And so you can see the steady uptrend that it had been on since 2014, pretty healthy increase. And then throughout the pandemic, as you think about the amount of money that was thrown at the consumer, trying to avert economic crisis, how much income's reduced. As you think about the COVID relief payments, that hit folks' bank accounts directly, as well as enhanced unemployment benefits and all the other programs that were unveiled. And you can see the massive increases that those had on inflation. Now, again, these incomes are on a real basis. So stripping out the effects of inflation, the top chart. And so you can see that aside, we're on a recent downtrend here, essentially pointing out how these increases, in inflation, everything that the consumer is paying, is certainly eroding what their real incomes are, their after-tax incomes, and the purchasing power, how far their dollar can go. Now, however, as it pertains to beef, retail prices remain very elevated, and certainly a testament in many ways to the strong demand that we've built over the years, and even over the course of the last 2 years. Again, as we introduce the consumer, the ability or the skill of cooking at home a little bit more, and other ways to enjoy beef. So certainly some positives there. However, it is certainly a threat as you look at it, and should always be taken with a bit of caution as you think about pricing ourselves out of the market. Not seeing many signs of that yet today, but again, as the consumer's dollar is being stretched for everything else, does that pose a challenge in terms of beef demand when you have beef prices remaining at all-time record highs, or near record highs, excuse me. But nonetheless, as I mentioned, it's hard to discount the fact that these retail prices are a testament to demand. The chart in front of you is looking at the retail demand index, a way we can strip out, understand how strong these prices are, and put some numbers around consumer demand. And so you can see that we're still on pace to have demand at the second highest level, in over 20 years for 2022. Down from a year ago, yes, but certainly, as you look back across the prior years in this chart and the general uptrend, hard to say that demand is poor by any means. And again, you think about that today, cattle, 83% of cattle are grading choice and prime. Hard to suggest that that's not a big part of this demand trend that we're seeing here today. Now, if you look at the same index, but look at it on the box beef cutout, and this would be a blend between the choice and select cutouts. However, you can see if you compare this year and the black dotted line for 2022 compared to a year ago, or even the 5-year average, we started off the year at some pretty stout demand levels, record high by this measure, again at the cutout level, at the box beef level, but really slumped here lately. And so this does pose a little bit of a caution flag to us relative to, or some of the buying segments seeing some consumer pushback, whether that's food service, retail, or exports, or some of those seeing a little bit of pushback from the end user and being a little bit more hesitant in the box beef complex. Is certainly a bit of a caution flag as you look at it. But we also recognize that over the past 2 years, for a lot of the time, the retail segment has been very beat up in terms of facing the wholesale beef prices that they saw relative to what they were able to turn around and sell it for, and being constrained on that side. Not to mention being constrained on volume at times. So is this simply the retailer recognizing that, hey, I have some leverage back in the box beef complex. I'm going to try to recoup some of those margins, especially recently while facing cost increases across the board. But nonetheless, something that we'll be paying pretty acute attention to. Now, flipping the script a little bit, looking across the country, again, talking about the drought situation. Now, the drought has certainly moved quite a bit from the last few times that we've been together and highlighted this. But nonetheless, as you look at the drought map, certainly not a pretty situation as you think about the amount of color on the map. Now, what's most significant is, again, where this drought has shifted to. We know that for the bulk of the last year, much of the drought was centered throughout the west and northern plains, and now it's shifted down into the central and southern plains. And you look at the dark red colors in the map, indicating exceptional drought conditions down throughout much of Texas. And what's significant about that is the number of cows that live in this area. With the movement of the drought, it's around 53% of the nation's cow herd that lived in a state with drought conditions as of April. So as the drought shifts and hits the nation's biggest beef cow herd, Texas, it's certainly sending up a caution flag relative to the impact of drought, even more so than what we've already seen over the bulk of the last year. As you look at pasture and range conditions, and this would be a weighted average, of the good, very good down to very poor conditions, you can see the index starting off at some of the lowest levels that we've seen in years. Certainly reflecting those conditions, poor conditions centered around where so many of the nation's beef cows live. As we look going forward, this would be the forecast from our meteorologist, Matt Makins. As you look out from the May through July timeframe. As you can see, precipitation on the top, temperature on the bottom. He's laying out the expectation that these La Nina patterns that we've seen for the bulk of the last 2 years do weaken, but nonetheless remain on the La Nina side of neutral for the bulk of the year. And as you do see, as you look at the color in the drought, the oranges show drier than normal, again, relative to those own regions, long-term average. And then the greens indicate greater precipitation. So you do see, especially through the southwest, portions of that receiving some much needed moisture. And then parts of the North Plains on the average to above average side of the spectrum. But unfortunately, it does show Texas, Oklahoma, and parts of Kansas, Colorado, New Mexico remaining in pretty in drier than average conditions. And then also you see the conditions forecast there out west. Again, these recent storms that we've had over the last week, and in particular over the last 24 hours in some parts of Texas, big relief to those areas. But nonetheless, with this type of forecast, certainly something that we'll all need to continue to monitor. But luckily, as we look out longer term, he is suggesting that, again, this La Nina pattern breaks down into year's end and transitions possibly into an El Nino pattern as we transition into 2023. But certainly recognizing that the path to get there, how much of a La Nina personality to a neutral pattern that we see between now and fall and winter is certainly pretty critical. Now, it's no surprise that we've also seen hay prices move sharply higher. Likely no surprise to anyone on this call this evening. As you look at the hay prices, U.S. average hay prices in the black line. And alongside of that, you can also see the impact, the rapid rise in corn prices that's had at the same time. Certainly somewhat different factors impacting these markets, but nonetheless, feed prices do generally tend to all move together over time. Now, looking specifically at the expectation for corn futures going forward, 2022 December corn futures as in the black line. And this chart compares it to last year in the red, and then a 30-year average, a 30-year index in the gray dashed line. And so you can see, whether you look at it seasonally, basis the 30-year index or last year, we are into that time frame where futures can often be tending to price in the upper end of the range. As you just think about, this time of year when we have planting concerns and concerns on, how the crop will turn out. But nonetheless, you've obviously juiced that situation this year by so much of the uncertainty coming out of Ukraine and the disruptions to the global grain complex there. And certainly, as we think about when we talk later about the calf market, this will be a big driver of feeder cattle and calf values. As you think about input costs, to get those cattle, to market-ready fed cattle, the impact here can be huge. And as we look at things today, considering all that we've priced into the market in terms of, again, broader uncertainty, global feed grain challenges, global grain challenges, plus some, the slow planting progress that we saw coming into the season, we're likely, whether this is the ultimate high or not, remains to be seen, but we're certainly pricing in the upper end of the range, would be our expectation today. But ultimately, how much relief we get will be a big driver of the trend in feeder cattle and calves. Excuse me, I guess I didn't get this text box updated, but as we look towards the beef cow inventory, again, beef cow liquidation has been up around 16% this year, and continuing to see more replacement quality heifers not being retained and making their way to town and showing up, in auction receipts and showing up in feed yards. And so as we look at it, pretty well bakes in the cake that we'll see a pretty significant decline in the beef cow herd on into next year. We have penciled in, roughly 600,000 or 2.1% decrease. And again, likely the lack of heifer retention bakes in at least one, if not two more years of declining beef cow inventories on into the middle portion of the decade. And as a result, slaughter should decline for several years as well. Again, simply thinking that calf crop becomes fed slaughter or beef production in 2 years suggests that the lows in fed cattle slaughter will likely follow the lows in the beef cow inventory by roughly 2 years. And so as we look out over the next few years, again, these tighter cattle supplies that we're looking at, not only producing, putting less beef on the market, supportive to values, again, at the retail, wholesale level, but also those declining slaughter numbers will again flip the switch and shift the packing capacity imbalances that we've seen for the bulk of the last 2 years and even pre-pandemic. And as a result, leverage will continue to favor cattle producing segments. And so even as the beef market remains elevated, cattle prices over the next few years will all gain on the beef complex. And so, regardless of these conditions, these question marks to the broader economy and the feed grain landscape, it's important to remember that these broader trends are still in play as you think about the impact of supplies and leverage shifts over the next few years. Nonetheless, here in the near term, we are pretty well stalled out in the fed cattle market. This is looking at fed cattle prices going back over time, clear back to 2012. And you can see up to this point, we've continued to maintain this uptrend since the cash market lows in July of 2020. Now, where we're at today, there's certainly plenty of risk that we do take out that trend line. As we do see just some pretty seasonal weakness to the fed cattle market throughout the summer. And ultimately, where those lows occur, is a big question mark. But it's again, as you simply look at larger cattle supplies during this time frame, it's certainly fair to expect that there remains some downside risk here over the next few weeks and months ahead. But nonetheless, again, we will, as we work, especially on into the fourth quarter, reestablish that trend higher going on into the next few years. So to roll this forward, specifically to the calf market outlook, and I think the place to start off is just remembering that there's a ton of things here, a ton of items on the checklist as we think about what's ultimately going to dictate where does the calf market end up this summer and fall. Now, you certainly have these broader cattle cycle factors at play. As we think about these tighter cattle supplies and simply the seasonality of the market. 75% of the nation's beef cows or the nation's herd is a spring calving operation, and those calves are weaned in the fall with a large portion of those marketed. So you always have some seasonal pressures there. Again, the level, how much it breaks into the fall, drought, how much early weaning do we have to see, and then those calves as they are weaned, what's the prospects for winter grazing as you think about the demand side. Again, feed grains and corn. If we see some relaxing again to the feed grain, to the corn complex, it does allow, again, to see more support in the feeder cattle and calf complex. And certainly supplies and feed yard inventories. And we'll talk a little bit about that. And then ultimately, a lot of folks like to say that the live is the drive. The live cattle market ultimately, is the dictator for feeder cattle and calf values, and the psychology there, so much oftentimes influenced by outside factors, volatility in the stock market, as we've seen here recently. And that psychology, whether it's specific to our market or broader, can have a big impact. So in terms of the supply situation, it's hard to argue that we have, simply less cattle out there. This year will be the third year of a declining calf crop. And as we look at this metric, the feeder cattle and calves outside of feed yards as of April 1, was down 4.2%, or roughly 800,000 head compared to year-ago levels, and just a stone's throw away from some of the smallest supplies that we've seen on record coming out of the back of the last drought. So certainly just less cattle out there as you think about the number of cattle that are out there. And we have seen where even as drought force movement has continued to push cattle in, it's certainly alleviated a bit of that feeling today. However, that will continue to become more evident. Now, in terms of the on-feed population, again, the smaller supply will start to show up here at some point. Now, certainly, the placements in April being higher than expectation did cause quite a bit of buzz. Where expectations were down, 6 to some folks expecting 10% from year-ago levels, and they came in par. Again, just reflecting that when you're in these drought type of situations, you can continue to dig into this feeder cattle supply much tighter than you'd expect. But nonetheless, it's hard to fade that trend of less cattle available. And so as we work, on into the third quarter, you can see the decline in the on-feed population that we expect to see. And so again, as you start to see feed yards with a few more empty pens, that's certainly a supportive factor to feeder cattle and calf demand. Now, specific to price, Yeah, as you look at 2022 year to date, we've been in an extremely tight range. You know, plus or minus 155. This is basis, our benchmark U.S. average 800-pound steer, but would show the same thing if you looked at the CME feeder cattle index, right around 155 for the bulk of the year. Now, nonetheless, as you look at these indexes that are outlined on the chart, the 20-year in the gray, or looking at these non-expansion environments, again, where you're heading into tighter cattle supplies, we will get that seasonal increase as we work on into the second half of the year. Really, the question is, to what level? And as you see the box outlined on the chart, our expectation is you do see a high, somewhere there into the mid-70s. Again, we're calling a plus or minus $5 range around that as we see things today. But again, those corn prices, if we get a bigger than expected break to the corn complex, or see, again, the drought situation turn faster than expected, we should, we'd certainly be looking at a market that's more supportive than outlined here. And also important thing to note, again, as you look at that non-expansion index compared to all of the last 20 years, a flatter trend through the end of the year, where in an average year, you do see more softening into the end of the year. However, in these non-expansion environments, you can be more supported. Again, just working into less cattle supplies. Relative to calves, as you look at the 20-year index, again, pretty strong seasonal pattern that as we do get into the fall run, we will see prices pressured. But nonetheless, as you look at the last 2 years, I think they provide a pretty good benchmark as you think about the potential pattern. 2021 and 2020, both exceptionally flat calf markets from spring all the way through fall and winter. And a lot of that, the transition into tighter cattle supplies and this cyclical bull market that we're in, poses the scenario where we could see a similar pattern evolve this year. And so as you look at it, our benchmark, we'd expect a low somewhere down into the 80s for this year. But the more important thing to look at is on a year-over-year basis, basically expecting that kind for kind, cattle should average roughly $20 per hundred higher than year-ago levels. Again, recognizing that that this benchmark isn't the exact price that'll apply to everyone, but where you sell, that $20 give or take would be our estimate today. Another thing that's important to think about is, again, the pattern of this market. Historically, this chart looks at comparing cattle sold on the summer videos to the fall cash market. Selling those cattle off the cow, take whether that's direct or via an auction barn. You can see that the pretty strong probability over time that these videos outpace the fall calf market. But you'll also notice that in some of these bull market years, 13 and 14 in particular, you actually do see where the fall cash outpaces the summer videos. Now, we wouldn't necessarily expect that to be the case here this year, and certainly, not to. There's certainly value in itself at the summer videos in terms of throwing calves in front of more potential buyers, but we would suggest that the price spread might be narrower this year. Again, as you just see a smaller break as you work on into the fall. And on top of that, again, as we work on later into the year and give more time for the market, again, the deferred live cattle potentially to firm up, hopefully see some stability in the corn complex, does favor that maybe those later summer videos outperform the early ones. And then flipping the script a little bit, looking at cull cow values, again, basis our U.S. average utility cow price. Strong seasonal, to see prices soften into the fourth quarter. Now, this year, we've certainly seen an extremely wide range in cow prices, and we would expect that the annual lows for the year are already behind us, and the annual highs are likely behind us. And pretty impressive, really, as you think about it, the number of cows that we've seen brought to town. Again, beef cow slaughter up 16% year to date, but nonetheless, we've seen cull cow prices at these kind of values. Now, they have softened here lately, but nonetheless, is a testament to where we are cyclically with just less cows out there. So again, as you look at it kind for kind, our expectation would be a roughly $10 increase in cull cow values on a year-over-year basis through the fall. So that concludes my section. With that, I'll pass it over to Tanner Ahearn.
Thank you, Patrick. And as I'm getting things set up here, if you guys have any questions that you would like to ask Patrick or myself going forward, or the Elanco representative, Dr. Thatch Winslow, here in a few minutes, there is a questions box, or you should have the option to type in a question. So feel free to do that if you have any here throughout the webinar. As Patrick said, my name's Tanner Ahearn. I'm going to walk through some of the recent survey results that we collected here, measuring 2021. Just to give you an idea of what the sample looked like, kind of the demographics out there. Last year, our average cow herd size was about 461 head, clearly way above the U.S. average that you would see in the USDA data set. But I think that's all right. It gives us a better representation of those producers that truly try to make ends meet from a financial standpoint, really pay attention to their costs, the revenue, marketing strategies, etc. Cash cow costs, which is important to note, do not include return to management or depreciation. These variables are going to vary quite a bit from operation to operation. You could probably tack on at least another $150, if not more, to the cash cow cost that you see here. But nonetheless, saw costs increase about $18 per cow. The more important thing is it was a record high number in our data sets going back several decades. It's probably not a surprise to anyone. Your cost may be a lot higher or lower than this, but I would imagine record cost probably applies to pretty much anyone. And where we're at here to date, I would assume that I feel pretty confident saying that we'll probably break this record when we collect the 2022 data. Luckily, calf revenue was up about $40 a head based off the survey results. So when you do the math, we did see profitability increase, although it was marginally increased about $20 a head for the cow-calf producers. Price is obviously higher, 21 versus 2020, and weights really pretty steady, or down just a few pounds compared to 2020. Obviously, with your annual and U.S. average cash cow cost, there's going to be a big range around that depending on operation to operation, and especially regionally as well. Continue to see the North Plains have the highest costs, then the South Plains and the Southeast consistently have the lowest costs. Our biggest numbers, or the biggest sample we would receive, would of course come from where a lot of the cows are across the Central Plains and the Southeast. The Corn Belt in the West would be a little bit of a smaller sample compared to those other three regions, but still definitely give us a good benchmark for producers to compare against. It's interesting to note that the Corn Belt was the only region that did not see a year-over-year increase from 2020 into 2021. So another interesting metric that we started collecting the last couple years, and I think it helps explain why we see the North Plains have such a high cost. This is looking at pasture lease in the charts on the left. So the way you look at it is the bars on the left-hand side, so the orange on the top and the green on the bottom represent the percent of producers that lease pasture in those respective regions. And then the next bars, the purple or the blue on the bottom, they represent, okay, of those who lease pasture, the leased pasture represents what percent of their grazing needs. You can see the U.S. average, about 55% of the producers lease pasture, and of those that lease pasture, it makes up just over half of their grazing demands. Compare that to the North Plains, where about 75% of the producers lease ground, and of those who lease, it makes up about 60% of their needs. The West, obviously a lot of public lands would probably fall into this, what you see here in these bars the last couple years. So you can see just the representation for the different regions. Southeast has the smallest leasing rate. When you tie it back to the cost, not only do the Northern Plains producers lease a higher percent, but their costs are also the highest for all the regions as well. And when you compare 2021 costs on a $1 per pair per month basis versus 2020, all regions, the U.S. average, everything was higher than 2020. Just plays into the fact of the higher cash cow costs, as well as just the inflation story that Patrick walked through. So as we think about some of the different things that you can do to help your operation, what we do in the surveys, we break the producers or the responses into 3 different categories. High return producers are the most profitable, average return producers, or low return producers, the ones that are the least profitable. And what we find year after year is that there's a few things that the high return producers do that they simply just don't take for granted and always put their focus on. That's animal health, nutrition, genetics, and marketing. And those top 3 bullet points have a significant impact on the most important economic trait for a cow-calf producer, and that's reproductive efficiency or fertility. So I want you to keep these 4 bullet points in mind as we go through the next slides and how they might relate or impact the results that we go through. So just jumping right into it, looking at fertility based off of calf crop percent or weaned calves per cow exposed. This is broken down by the producer returns. You can see the high return producers find a way to be the most productive or most efficient when it comes to fertility. You know, the 3-year average from high return to low return producers, it's a difference of about 3 percentage points. Going back to our average herd size of 460 head, that's about 13 or 14 calves that more calves that they can market, and less replacements that they need potentially as well. You can see the U.S. average the last couple of years right there around 89%. Taking it a step further, looking at calving length or calving season length sorted by returns, about half of your high return producers calve within the first 45 days, and then about 80% of your high return producers calve within the first 60 days. I think we'll go through a couple more slides to show the benefits of this. I realize that 45 days calving window isn't realistic for everyone, but I think a target of about 60 days or less is certainly something we should all strive for if it's practical for your operation. You know, obviously you don't want to make a big change in 1 year because of some of the economic implications of that, but I think it's definitely something to consider if you're stretching out more than 80, 90 days plus. So some of the benefits of a tighter calving window, you know, for one thing, it gives your females more time to breed back, and that shows up in the data here, looking at your weaned calf crop percent based off of your calving season length. Those that calve within 45 days, they consistently have a higher weaned calf crop percent than those that stretch it out for 2+ months. You know, that's the difference over the last 3 years of about 4 percentage points. So again, makes a big difference on your bottom line and your efficiency and productivity. See the same thing on the weaning weights. Heavier calves weaned, the tighter the calving window. At the same time, you would anticipate this is a more uniform calf crop, would also improve the marketability of your calf crop as well. So just some things to consider, and that there is data to back up a tighter calving window does prove to be beneficial in some of these different key production indicators that we measure year after year. So if you've been connecting the dots, you're probably not surprised to see that your high return producers wean off the heavier calves all make sense based off the last few slides that we've shown here. This chart down here is looking at your annual average steer weaning weight going all the way back to 1980. From 1980 to 2021, we increased steer weaning weights about 82 pounds, or about 2 pounds per year. The bulk of that increase came within the first decade, from 1980 to 1990, where we increased about 5 pounds a year. Here, over the last about 30 years, we've only increased about 30 pounds, or 1 pound per year. You know, as we think about this year with some of the drought conditions, I think that definitely has an impact on weaning weights, as we see here early in the last decade. But if weaning weights are kind of flat or stagnant, I think the environment is limiting our genetic potential. If that is the case, it just becomes that more important. If you really can't maximize or increase your weaning weights anymore, your calf crop percent, your marketing, your risk management becomes that more important if we are kind of capped to some degree on the weaning weights. So if you're going to sell more pounds and you can't increase your weaning weights, you need to sell more calves, maximize your weaned calf crop percent. So some of the different marketing strategies or things to think about is incorporating more of a weaning protocol potentially. This is looking at weaning length and calf value. The bars correspond to left-hand axis. And then your values here at the top are kind of standalone. They correspond to each category, but the bars correspond to the left-hand axis, where we see about 20 to 25% of the producers ship their calves right off the cow. And then in our data set, about 50, 55% of the producers wean for more than 45 days. When you compare the calf value for weaning versus shipping right off the cow, 3-year average difference is about $110 a head. However, if you compare these two calf values, it's actually a discount on the 3-year average. These calves are actually bringing about $30 a head less than those shipped right off the cow. And then this data set average is about par. So the main takeaway here is if you're going to wean your calves, you need to do it for at least 45 days. And anymore, we're starting to see weaning programs that require calves to be weaned for 60 days or more. So if you are going to put them through a weaning protocol, definitely recommend at least 45 days. Otherwise, you're probably taking on more risk and not getting the return, taking on more risk from a morbidity and mortality standpoint, not getting the calves a chance to regain some weight if they lose it early on. So definitely take that into consideration. Looking at the different marketing avenues, we get this question a lot. What do people, or how do people market their calves, or where? Continue to see the auction barn be the most popular option. You will notice that these calf values are the lowest compared to these other categories, but I think a big part of that goes back to the fact, the seasonality that Patrick touched on earlier. A lot of these cattle sold through the auction barn are going to be sold in the spot market in the fall, where you typically have your lowest calf prices. So I think that's a big reason why you see the lowest prices on auction barns. You know, when it comes to marketing cattle, you know, another big thing is vaccination. Anymore, if you don't vaccinate your cattle, it's a discount, not that you're necessarily receiving a premium for vaccinating them. As you look at the demographics in our results, about 2/3 of the producers vaccinate at branding. Then you continue to see it slowly decline going forward. I am encouraged to see that very few of our survey participants do not vaccinate. Tying that back to the calf value, again, we have about 30% of them vaccinate at least one time, and then we have about 45% that vaccinate twice. When you look at the calf value, there's a positive correlation. The more times you vaccinate, the higher the calf value. Now, I don't think that's the only reason why you see the higher calf value, but the fact that there's a strong correlation year after year, I don't think that's just a fluke. I think there's definitely something to it. And if we were to look at other data sets, it would show a premium as well, the more you vaccinate. Looking at the genetic side of things, obviously this is pretty important for cow-calf producers. Same thing, the bars correspond to the left-hand axis. The calf values kind of stand alone for the respective categories, but about 50% of the producers purchase a bull that costs about $2,500 to $5,000. Then on the other hand, you have anywhere from about 20 to 30% that purchase a bull from $5,000 to $7,500. When you look at the calf values, the 3-year average difference from these two categories is about $75 a head. Now let's assume you keep that bull in service for about 3 years. He sires about 25 calves each year, 75 in total. $75 a head times 75 calves is a total of about $5,600. Again, I'm not saying all of this calf value is strictly from the better genetics or the more expensive bull, but again, there's a positive correlation year after year. So there is some data that would justify maybe spending a little bit more on genetics, and in the long run, it will likely pay off. And then the last slide here, looking at the female side of things, we asked the question, what's the expected useful life of the cow herd, or when do you expect to cull your cows? The average over the last 3 years is about 9.5 years old. In my mind, that seems a little optimistic or a little bit on the high side. And I would say, just as you are in the female market looking to purchase females, make sure you take that into account, or take into account a practical lifespan and how long you keep those females around. I'm sure there's several cows out there in your herd that are 10, 11 years old or more, but I find it hard to believe that your average would maybe be that high. So, and just a comment on the female market, another reason why to keep this in mind going forward is, as the calf price, the fed steer price, the stalker price goes higher into the middle of the decade, as Patrick laid out, your bred cow value will follow that trend as well. And so we could certainly take out these highs that we saw there in the middle of the last decade, and those females that were purchased in that the cycle peak, it was probably pretty hard for those cows to pay for themselves unless they do stick around for 10, 11, 12 years. So something to keep in mind going forward, especially with where we're at in the cattle cycle right now. So walk through a lot of survey data. Again, I think it's more of a benchmarking tool. There's certainly going to be some ranges around the different weights, the different metrics, the different costs, but certainly I think the trends are more important as you evaluate your own operation going forward. So with that, I'm going to change it over to Dr. Thatch Winslow of Elanco Animal Health. Again, we do appreciate their sponsorship. They've been sponsoring this webinar for several years now, and I know they have a very busy schedule, so we appreciate him taking time out of his evening to join us.
Tanner, thanks very much, and we appreciate so much what CattleFax does for the industry. And that presentation really excited me, just because the value you showed on those early conception rates. And Dr. Perry has just completed some studies on virus shield versus live vaccine pre-breeding, and the value of pushing that back and getting those conception rates, getting those cows bred earlier and a higher conception rate. So reach out to your veterinarians and your animal health consultant, visit about virus shield and how that could impact conception rates on your herd. That being said, I'm here to talk about parasites, management, and mitigation, and the title here says the R words. And so to keep you from guessing as we move forward in the presentation, those two R words are resistance and refugia. And I think a lot of you have heard those words thrown around in the past decade or so in regards to cattle parasites. And Resistance, of course, that's lack of efficacy in our products, and typically that comes from extended exposure to the molecules, extended use, frequent use, and the old paradigm of deworm everything often and kill the parasites is no longer working, and especially with practices like using our macrocyclic lactones, especially the cheap generics for fly control, frequently in the summer, that also increases exposure to parasites and has made our battle a little bit tough. So my slides, there we go. $2 billion cost to the industry is pretty significant. What does that mean to the cow-calf producer? Really, it's about $165 per cow-calf pair per year in the cost of parasites. And traditionally, we thought of that as, we think of parasites as being the rough hair coat and the diarrhea and the bottle jaw. Really, that clinical parasitism is a minor part of it. The major cost that we see to parasites in the beef industry is the subclinical, the stuff that we don't necessarily see, but we certainly can measure. Cattle with a heavy parasite load, especially Ostertasia, we get a decrease in appetite. The cattle eat less. What they do eat, they digest poorly. What they do digest, they don't absorb well. And then the result of that is stunted growth and poor weight gain, delayed puberty, and reduced reproductive performance. Mama cows are making more milk, and the result of that, certainly those heifers are making less milk, and therefore we're having lower weaning weights and increased susceptibility to disease. So let's get down to the real nuts and bolts of parasites. Just about every product out there, every parasite, anthelmintic, every dewormer, has a label for 30 or more parasites, and that's all well and good. But I always ask, who's who in the world of cattle worms? Which ones really make a difference? And these are my top 5 that I show on the slide. But this slide, I love this because it from left to right, it shows us which parasites are most pathogenic, or which ones from left to right are costing us more, less profitable to the cow-calf producer and the industry. Stocker background, or same thing. And then going up on the left side is how common are they? How likely are we to see them? And if we take home anything from this slide, or maybe this whole presentation, it's that Ostertasia owns that entire upper right corner. The brown stomach worm is not only the most pathogenic, but it is also the most common. And through it decreases appetite, decreases digesting, decreases absorption, causes protein leakage, and it really robs us from dollars. That being said, if we look at lungworms and homuncus, those can be very pathogenic. And as a matter of fact, in sheep and goats, homuncus is the most pathogenic. But fortunately in cattle, these are not as common, and so they don't make that upper right-hand corner, but they're still very, very worth controlling and being concerned about. And then we jump up in the upper left corner and look at the ones that are far less pathogenic but far more common. That would be Cuperia and Esophagostomy. Cuperia, we're seeing more and more of that because of our continued use of the macrocyclic lactone dewormers, and they're just not as effective against Cuperia. So we're seeing more of them, but fortunately they're not near as pathogenic as Ostertasia is. And then the rest of the parasites are not as significant in regards to the others. And so one of the other things that Ostertasia does, it kind of eludes Mother Nature in that those larvae, the worms, when they're inside the cow, they have created an ability to go dormant or inhibit themselves during times of the year, seasons where pasture conditions are going to be unfavorable for their survival. So if you live in the north, in the northern states, you're going to see Ostertasia inhibit during the winter time. And then if you're in the deep south, in the southern states, you're going to see inhibition of these larvae in the hot, dry months of the summer. And then unfortunately in the parasite belt there, you're going to have a little bit of both, making it a big challenge. So not only have they protected themselves from being, excreted in the feces and immediately dying, they're waiting until to a season where that won't happen. But also those larvae, while they're arrested in the L4 stage, they're a lot tougher to kill. And so we need to have products that are highly effective against those. So we're back to our words, and again, that's resistance and refugia. And refugia really is I'll try and explain with the slides, but it's the idea of having a population of parasites, some refuse that we are able to actually do something with. And so if you look at this, what I'm going to call an adult healthy cow right here, and what do I mean by adult? I mean 4 years old and older. And what do I mean by healthy? I mean a body condition score of 5 or less. And so our heifers, this doesn't apply to, and our thinner cows, it doesn't apply to. But our adult healthy cows, they're grazing on a pasture. They've got a population of parasites that are predominantly susceptible. There's a few resistant ones there just naturally. And if we deworm that cow, who can probably take care of her parasites through immune system on her own, then what happens is we slowly start selecting for a population of resistant parasites. And those resistant parasites become predominant, and we end up with resistance in that pasture. And then on the other hand, if we don't deworm and we let the immune system take care of those parasites in those healthy adult cattle, then we maintain a population of parasites that are predominantly susceptible, and we have that refugia, that ability, that parasite population, both in the animals and in the pasture, which is very important to understand that parasites are in both places that we're able to kill. And so you ask, well, if we're not going to deworm them, why do we need to be able to kill them? It's a good question. It's really because when we look at profitability on a cow-calf operation, all the dollars, folks, are in the calf right there, and in those yearlings and in our replacement heifers. So we want to, we can make big gains deworming these calves, and it's important that we maintain that. So again, if we look at that model where we frequently deworm, then we produce a population in the pasture that is predominantly resistant. That becomes the population in the calf, and our deworming is fairly ineffective and therefore not very profitable. On the other hand, if we recognize that those cows are most likely going to have a capability to fight the parasites on their own, then we're gonna have a population that's got that refugia we're looking for, a population of susceptible parasites. And that's what will be in that calf and those replacement heifers. And we deworm them, then we're gonna be very successful at that. So, we question that immunity. There's been university studies on that to show that adult healthy cattle have immunity against these parasites and keep populations down. We've also done quite a bit of work with some large ranches doing fecal egg counts and copriculture, looking at species of parasites, and we're showing the exact same thing there. So this is kind of my conclusion slide right here. The bottom line is if we look back at the old paradigm of deworming cattle frequently with products, the entire herd very frequently trying to eliminate that population, it backfires on us. We get resistance, and then we get parasites we can't manage. And so there's a lot of tools out there: dragging your pastures, resting pastures, this 4-3-year system of only deworming cows that are a body condition score of 4 or less, or a 3-year-old or less. There's some management techniques. We can, as I just mentioned, we can do species-specific quantitative analysis. We can look at do fecal egg counts and then see what parasite species they are. Are they Ostatasia? Are they Cuperia? And what products we use when. We can do combination dewormers. But the bottom line is we need to start thinking outside the bottle. We need to be taking a much bigger management mitigation approach. At Elanco, I like to say that the right products and the right animals at the right time, nothing more, nothing less. We're trying to build a lifetime of productivity and health for our herds. So that finishes that up real quick. Hopefully we made it in the clock, and if there's any questions or comments, I'd be happy to address them. Thank you again.
All right, thank you, Dr. Winslow. Appreciate the insight that you provided there. Definitely some very timely and relevant information. And again, appreciate Elanco's support. Do have a few questions that we'll get to in just a second. But before we move on to that, just want to throw out some upcoming CattleFax events. Have our risk management seminar where we'll kind of hone in on your own operations, risk management strategy, and then also look at the tools that we're using on a daily, weekly, or monthly basis. Would take some last minute registrations for the one coming up in June, then also have another one in September. And then our corporate college kind of gives you a broad overview of the industry, as well as the trends we're seeing and some of the factors impacting the industry. All of these seminars are hosted here at our office in Denver, and definitely get a lot of one-on-one time or small group time with our analysts. So if you're interested in that, you can find more information on our website at cattlefax.com. And then we'll go ahead and jump on into the questions. Patrick, we've got one here that kind of touches on the material that you covered. You know, what does the next May, June, and Fed market look like? You know, think about a producer that weans this fall and then retains ownership and then sells them next May or June. What are your thoughts on the May, June market? I know that's a ways out there.
Yeah, I mean that certainly is a long ways out, but you know, as we look at it, you know, the broader cyclical trends that we presented will certainly be at play. So expect that the May-June market will be higher than what it is this year. Now, for instance, the futures markets today, June 2023 is trading about $15 above the nearby June contract at roughly 148. And at their highs, they got as high as 152. So, you know, to me, I think, you know, maybe between those 150, you know, for second half of June might be a fair expectation, you know, just based on where the futures are and where they've been. You know, within that, I think I would probably lean towards taking the higher side of that by the time we get there. But I think, you know, even with that, have to recognize the economic risks that are out there and the potential demand risks that maybe the market does, you know, not quite reach, or that does become a drag on the market as we get to that time frame. But nonetheless, higher, you know, certainly higher, you know, than this year, you know, is the trend, and that supply trend, again, as we work into tighter cattle supplies, will continue to show up. And would also say that, you know, nonetheless, that May-June market will be, you know, something lower than the spring highs as you start rolling off the spring highs. Do you have anything to add to it, Tanner?
No, I think that makes a lot of sense, just given where we're at in the cattle cycle and everything. It certainly better prices should be expected next year. Do have another question here about the survey data that I walked through, just a little more clarification on the calf crop percent. The way we look at it, or the way it's asked in the survey, it's measuring weaned calves per cow exposed. They wanted some confirmation. Does it include heifers or cows? The way we worded it's per cow exposed, so you would have to assume the producers completing the survey are looking more at their cow herd, not necessarily their first calf heifers. But good question. And then another question on the survey data, asking about the cost of bulls and the genetic slide that I pulled up there. Does that translate to AIing and for better genetic bulls, or utilizing artificial insemination for the better genetics? In our data set or the survey that we conduct, we don't mention anything about artificial insemination or anything like that, so I can't directly answer if there is a correlation, natural versus AIing, or how that may play out. But if you assume a bull that is in an AI stud, if you assume those are better genetics potentially, I suppose that would also apply to the survey results that we have or that I completed. And again, back to that slide, you know, I don't think you necessarily have to go out and buy the most expensive bull that's out there, but certainly assuming a higher price bull, a more expensive bull has better genetics, you do see a correlation over time. So with that, I think that's all the questions we have here tonight. If anyone has any follow-up questions over the next couple days, don't be afraid to send an email to myself or Patrick. You can see there on the screen. If you have a question for Dr. Winslow or the Elanco team, you can certainly send that to us and we'll pass it on to them. We did record this webinar, so we will post this tomorrow, and those that registered for the webinar will receive an email tomorrow with a link to the recording so you can go back and review the material. So with that, I know we've gone over time. I appreciate everyone sticking around, and I appreciate everyone joining us, and hope you have a good rest of your evening.